Welcome, everyone, to another exciting episode of the None of Our Businesses show. I'm Ty Carr, and with me today is Tammy Hess.
Hello, everyone.
And we are, as always, accountants, this time two accountants, talking about news, business, tax news, just general news. Well, actually, just business and tax news this time. And we're talking about that from the perspective of a couple of accountants. So, what do we have on deck today? Well, John Deere, the tractor company, they do some other stuff too, but John Deere employees are on strike. And an article that I posted on LinkedIn, the C Corp Magic Shield, why I think it probably doesn't work for you. Then we're going to get into Best Buy, the electronics retail company. Well, they are getting into healthcare. And finally, does being a tax preparer place a higher burden on you when you're filing your own taxes and being evaluated about committing fraud? Okay, well, let's get into it. We'll start with Tammy and John Deere.
So I have an article today. This Wednesday, United Auto Workers went on strike at Deere and Company after voting down a collective bargaining proposal. Most of us are probably familiar with the green and yellow John Deere equipment, as it's been a staple business over decades, and many country songs make reference to it. There are several good articles regarding this strike. However, the article from Des Moines Register provided some good context as to what led to the strike. And basically, the company has been reporting record profits over the past few years, even seeing growth during the pandemic. It has been reported that the CEO received over $15 million in 2020 based on the company's good performance. While things appear to be going well, the company has struggled in hiring people and keeping people, which we've seen in many companies as well. It's important to note that the proposed bargaining agreement included increased wages and retirement benefits, but it was rejected with 90% of the members saying no, many stating that it wasn't good enough, and some stating that they felt the company owed them better wages after they had worked during the pandemic. What appeared to be the tipping point was Deere and Company's recent projection stated that they plan to earn just under $6 billion this year. So for now, over 10,000 Deere and Company workers are on strike during a time where the company's production is already struggling and keeping up with demand. While it may be difficult to predict how this will be resolved, I am curious to discuss if this could have been prevented in the first place. We have seen other manufacturing companies offering premiums or bonuses to encourage workers to work during the pandemic. And we've also seen companies who share record-breaking profits with employees. I guess my real question would be, is it better to be proactive and, increasing the economic conditions of employees, or wait until they quit, or in this case, go on strike? What do you think, Ty?
I generally think it's better to be proactive, to stay out ahead of that kind of thing. I'm in a different industry, and my philosophy probably doesn't always make sense or work in every context. I'll kind of circle back to my thought on that, but I think, to this point, I think what they said is that in the article was that the last time that John Deere had a strike was like 1989 or something like that. So, from the description in the article, I think, we can infer kind of a criticism of the company of not getting ahead of it. But, to go that long without any kind of labor dispute, or at least not of that magnitude, I should say, indicates that they generally seem to have a policy or a philosophy of doing what they need to do for employees. So it seems curious that it would take this turn at this moment. I don't know what to make of that particular thing. And I guess if you're looking, the obvious difference at this moment is the pandemic, right? I thought that was interesting. I guess I have more to say, but I don't know if you have any particular thought on that point, Tammy.
Well, yeah, I think it's twofold. I think that there's working through the pandemic and kind of getting through that, and seeing that this particular industry wasn't impacted negatively as others, that there's probably more of a sense of a thank you is kind of needed, or it's kind of like a unique situation. But if they're working really hard and sales are going up, that it probably would have been best for the company to think about how would we be rewarding our employees for working through this, where so many people either couldn't because of different factors, like they weren't allowed to go to work, or so many others are opting not to go to work. So I think that is a little bit of a nuance. And you're right. I mean, the fact that they haven't been the employees, I think it was like 35 years, right? But it was for a completely different, the timing was different in terms of that was the opposite way. They were going through a farming kind of meltdown, I guess, for another better lack of words, but and so they were seeing a huge decrease in their activities and their stuff. And so I don't know what the other reasonings were for that strike 35 years ago, but I would say that this is quite different, and it's a unique time all the way around. And so yeah, I think I would have probably encouraged and been a little bit more critical of the company to say, how do you reward folks? Because I do think that the red flags, that was the other part I was going to add to that there were some red flags that were coming in where people were quitting before this happened. They were having a hard time bringing people on. And so thinking through that process, is they probably did have some indicators that their employees were unhappy. Now, how did it go from 0 to 60 so quickly? I'm not sure, and maybe quickly is not the right word either, because it's been, over 2 years now in terms of the pandemic kind of living through it. So yeah, I guess missing those indicators is probably the biggest thing I would probably think about.
And I think what's also interesting about that, which I think is more of a big company dynamic, is this, when you talk about those indicators and you think about it, like the company losing people, not being able to hire enough people, I mean, that's got to negatively impact operations, right? So, as much as they are doing well and profitable, you have to consider that, could they be doing better? Or are they missing the investment that would be necessary for them to do even better, right? Mm-hmm. And I think so. What happens, I think, sometimes in these big companies is that when you have such a large organization, people think of unions as being, people always think I think a lot of times people think of unions as being, okay, they're labor, and then management is corporate and investors, and we're on completely opposite sides, and we're all negotiating for just our own interests. But when you think about it, like if you think about those factors, if labor's overall theory could be correct in terms of not only do they deserve more, but by getting more, that could improve. Well, they didn't put this forth necessarily. I don't know if they put this forth, but I'm putting it forth. By labor getting what they want, it could in fact improve operations. It could in fact improve profitability. And so I think that's what's interesting about larger organizations, is that sometimes that shared governance between kind of the labor and corporate management is helpful to getting to actually the optimal answer for what's best for the overall organization and for all around. In other words, on the surface, it may seem like, well, if the union gets what they want, then labor wins and investors lose, but maybe not. Maybe actually that, this fight is between management and labor. And if they fight it in a civil way and they come to a good conclusion together, that investors actually win in the long run as well. And I think that's an interesting dynamic to think about in the large company environment.
Mm-hmm. I do too. And I think the other thing that's interesting, we could probably go really deep into this one, but the other thing that you also see is the fact that they've mentioned the fact that the CEO received $15 million because of the good performance results. And so you always kind of then wonder, that was maybe his incentive or his bonus, but then what was the bonus or incentives for those who were actually building the product and the machines and the equipment to get those out there? And, I always find that fascinating, because whenever you hear employees that are unhappy or saying that they're underpaid or undervalued or not receiving incentives, they will, share those higher dollar incentives to the upper management. And does that seem fair in that mm-hmm. sense?
Mm-hmm. Yeah. And I think I want to circle back to the question, which I think has a different flavor, your central question of, is it good to get ahead of this, right? And I think that has a different flavor in the industry that I work in, or in the industry in where we lead, because in our business, it's, we're leading professionals, and there is a marketplace, a market a market salary, a market compensation that it is often hard to zero in on exactly what that should be for an individual person, because you're weighing multiple variables, including their tenure in the industry, as well as kind of their overall, the quality of their experience and so on. So I don't want to make it sound like it's just an obvious number that you can pull from some chart, but there is a theoretic, there is a idea there that you could try to stay within market rates, which is typically what I try to do. So in terms of getting ahead of it, normally in a normal environment, my overall philosophy is, keep as a leader, keep an eye on what market rates are for the kinds of people that are working in your team, and make sure that you are staying in line with that for the people who are on your team. Why? Because I think a lot of times in our world, what happens is that we get good people on our teams and then we just take advantage of them, and we don't do that. And we wait until they figure out that they have a higher market rate. And then they, if we're lucky, they come to us and negotiate for higher pay. But more often than not, they figure out that they could be getting a lot more somewhere else and they just leave us. Mm-hmm. And so from my perspective, I do like to stay ahead of it in that way. But what's weird about the current time frame we're in is, is that when you bring that philosophy down to a lot of job categories right now, even if you pay what your competitors or the other businesses in your industry pay, it very well may be that's still not enough to keep people around. And it gets to that issue that in the article, when they talk about, feeling like maybe they deserve more for the prior work that they did during the pandemic, right? And I think that is an interesting, I think that my philosophy doesn't address that issue. It doesn't address how do you give people, like if our firm's profits are up and, people feel like they deserve more, how do you share that with them, even if irrespective of market rates, right? And you can see where that could happen, and you could have these scenarios where market rates are not otherwise up, but you're doing well. Do you I think that leads that question: do you share that with the team, kind of thing, right? And I guess my gut feeling, I haven't experienced that particular issue, but my gut feeling is that I would like to think that I would. I want to have a sign in the back of my office for my own sake that reminds me on a daily basis that says, don't be greedy, because I think that so much goes wrong from a leadership perspective when you put your own wants and desires ahead of the rest of the team all the time, and that's what we see. And I think particularly I think we have the advantage in a small business environment with small teams to empathize with our team members and really feel that they're our friends and they are people that we know and we care about. And it makes it easier for me to adopt that mantra, don't be greedy, and not do that. I think it's so I don't say that like I'm on some high horse and I say, well, I'm not greedy, but these corporate CEOs are, because they're they're leading a totally different kind of thing, and when they're leading at scale and lots more people than I'm leading, it's a different game. And so I can only say what I believe for me. I'm not saying necessarily that means that what we see others do is wrong or that they should do what I do, but that's my perspective on it.
Yeah, I think that's good perspective. And the last thing I would say is that if you're playing catch up and you're having those conversations because either people are quitting or when they come to renegotiate or they're going on strike, it's going to be, I think the company or people end up paying more, because not only do you have to kind of go over the sense of, I felt like I had been cheated, right? And so it's because the article said that I think the range of the wage increase was between 3 to 5%, which may, if they had done that 6 months ago or a year ago, could that have met the people's needs? Was that the market rate? Was that whatever? It could have been the case, but now you're in a situation where people are upset. And so there's another kind of premium that attaches that or to that. So it is something to think about before it happens or before you have the conversation. And it is always better when you have employees that can come to you before they decide that they are wanting to leave or quit and have the kind of an open dialogue. But I would say that most companies, especially to your point, larger ones, don't have that channel kind of available where they're having those discussions before. So it is, I'm coming to the table and now I'm with my resignation, or I'm coming to the table with whatever my demands. And at that point, it is probably too late in the game. But you have our next article.
Yeah. And I am going to talk about an article that I just posted myself this morning on LinkedIn. I titled it The C Corp Magic Shield Probably Doesn't Work. And so just as a quick background for our listeners, I think a lot of them probably know some of this, but I'm gonna give us the background on this. Is that, if you have a C corporation, I'm talking about a tax structure for your business here. If you structure your business for tax purposes as a C corporation, then that corporation will file its own income tax returns. It will pay its own federal income tax on its profits, and that's all done separate from the owners. And I'm imagining in the context here, to keep it simple, that the owner or owners of that C corporation are individual, what I'd call natural people, right? And so, the fact that that C corporation, your business, files its own income tax return, pays its own tax, is often seen as not the most optimal tax situation for a small business, because for the natural person, the owners, to ever get their hands on that cash, the profits that the business earns, not only does the corporation pay tax on that, but we have what's called the double tax, because the natural person ends up paying tax when those profits are paid to that owner, that natural person. And that's often in the form, the most common scenario, the common format for that payment would be what we call a dividend. But there are other transactions that it could end up being, but all roads lead back to the same point, which is the C corporation pays tax on the profits. And then for the natural person owner of that corporation to get any of that cash, they then would have to pay another layer of tax for federal purposes anyway. And if your state has an income tax, it may work that way for your state as well. So for that reason, classic tax planning for small businesses would say, well, you probably don't organize as a C corporation. Now, there are exceptions to this. And one of the key exceptions that I've taken exception to this exception. I've talked about my concerns about this kind of advice before, but it's still out there, and it happens. And that is the idea that if your business has an extremely risky cash flows, and you're running such a risky business that you're not even sure that you can maintain the cash after you generate some profit, you're not even sure you can maintain enough cash to pay your business income taxes. Now, I'm kind of saying that with a little bit of a wink and a nod, because really, if you had the profits, you could set aside the money to pay the income taxes. So what you're really not sure of is that you can kind of manage the business and the cash well enough to make sure you keep that cash there to pay the taxes. That's probably a better way to say that, right? But where we see this in recent, this could be a fact pattern for a number of different small business scenarios, but commonly where I see it happen often is in the cannabis industry, where cannabis businesses will elect to be taxed as C corporations for this exact reason, because they've got a high tax burden on profits due to the application of Section 280E that does not allow them to deduct anything but their cost of goods sold. And they're loading that company up with all kinds of non-cost of goods sold operating expenses, which depletes the cash available to pay taxes. And so a lot of lawyers and consultants have advised companies in the cannabis industry. And again, lawyers and consultants had advised other risky companies of this before the cannabis industry, but it's been a fairly rampant set of advice in the cannabis industry. They will advise these small businesses to elect to be C corporations. And it's based on this conceptual idea that because the C corporation is its own taxpayer, the federal income tax obligation of that business then is an obligation of the corporation. not an obligation of the individual owners. And because of that, the state laws that protect the liabilities, protect owners from the liabilities of their corporations, will protect the owners of the corporation from the income tax debt, the business tax debt. It'll protect those business owners, the natural persons, from the IRS, because it's a debt of the corporation and there's supposed to be a limited liability shield on all debts, including taxes, presumably under state law. And that under that theory, it makes, it sounds like it makes perfect sense to then treat that as a C corporation. Now, I agree, I call this C corporation barrier that they're trying to set up a magic shield in my article. And I agree that magic shield is theoretically possible under the law, the way I just described it. My problem with this whole thing is that in my experience, it's functionally impractical for the vast majority of small businesses. And to explain why I think that, I ran across another recent federal tax case that addresses this issue. And just for good measure, it's not even a cannabis company, to point out that this happens in the non-cannabis world as well. So a recent federal tax case in the Fifth Circuit was a company called Pickups Inc. And it's a used car business that was structured as a C corporation. And that C corporation was owned by a single owner, a single person. And that person was named as the official officer and director of the company. And so the IRS basically concluded that that company racked up a tax debt, a C corporation tax debt that it couldn't pay or it didn't pay. And the IRS went after the individual owner, the individual taxpayer, and said, well, you have to pay this because we don't really believe that the company was substantively different than you as an individual, as an owner. And that tax debt turned out to be about $1.7 million for what that's worth. And in the final analysis, the district court where this went to, and then later the Court of Appeals, both agreed with the IRS on this point. And what they they flat out called the corporation the owner's alter ego based on several factors. They did cite the fact that it was only owned by this one person to begin with, the company. Although I would suggest that that's kind of a lesser important factor overall. They discussed that he exercised complete dominion and control over the company. I think that is an important factor in this point, because I think what often happens is people think, well, they can basically be irresponsible about their corporate tax debts and then use this magic shield to protect themselves individually. And it just doesn't smell right. That that's not going to hold, that if you have complete control over what that company does and you choose to pay other bills other than the IRS, you making that choice as the person of complete control of that company are definitely putting yourself at risk. They also cited that, and this one's kind of the key issue to one of the key issues to me, is that they cited that the owner failed and the company failed to observe corporate formalities. Well, what does that mean? Well, there's corporate formalities means how you do your accounting. Do you do proper accounting that separates the company from its owner and maintains appropriate company books? Do you have proper contracts and agreements between that company and outside parties, including any transactions that may occur with the owner? Do you keep the corporate minutes? You get into some legal things that need to be done in order to maintain the legal liability of a corporation. Another factor that they brought up was, that he had loaned substantial money, that the owner had loaned substantial money to the company. Well, that's a very common fact pattern in a lot of small businesses. And finally, that the company cash flow was used to pay some personal loans from the company's bank account, which is also, in my experience, a fairly common fact pattern in a lot of small businesses. So, as I said before, what the courts ruled in agreement with the IRS is that this company was nothing but the alter ego of the individual taxpayer, and therefore that individual taxpayer had to take on this obligation, that he couldn't use this as a shield and say, well, it's the company is the one that owes it, not me. Now, I think, when you look at this scenario, I think a lot of folks who might disagree with my assessment of this will say, well, we're not going to have that problem because we're going to do everything right. Or the lawyer or the consultant who advises companies to set up this way may say, well, the setup is proper as long as they do everything right, they'll be fine. But that doesn't consider the cost of doing everything right. So in my view, the problem is not simply that, this business or other small businesses just can't get their act together. I'm looking at this from a business standpoint. The cost of getting your act together, of so-called doing it right, is often probably not worth it. And at very least, it has not been evaluated. Because what happens, there's cost to defend this kind of structure, to set the structure up and then make sure that it actually, your magic shield actually works. There's ongoing costs that you have to incur in paying professional accountants and lawyers to maintain your corporate books, to maintain your corporate documents, to maintain all your contracts with various parties, and to make sure all the corporate annual paperwork is done correctly. And I think that's the piece that a lot of lawyers and consultants and their clients fail to really talk through and do a thorough analysis of at the get-go. And so, and like I said, I've rarely seen where that's worth it. And in my experience, most operators aren't going to do all that work after it's set up, which means that the cost and trouble to set that structure up in the first place was a complete waste. So that's it. I've unloaded my particular opinion on this whole kind of thing. And what do you think about that, Tammy?
Well, first, let me just start off by saying the visual of the magic shield and the alter ego kept on ringing in I kept on seeing that as I was reading this article. But I guess I would agree. I think that in order to actually make sure that the structure is correct and that it's actually operating the way it's supposed to with all the rules and regulations and all the stuff, does take a lot more effort and time than what people kind of think about. And not only just that, but sometimes it's impossible to actually achieve, right? In the case where the owner was loaning a lot of money and doing all this kind of stuff, that happens in a lot of businesses that you can see. So my question or my thought process is, would the time, energy, the money, would that all be better spent trying to figure out a way to pay your taxes or whatever that may be, rather than trying to avoid it or delay it? Because at the end of the day, you have to pay it, right? This doesn't go away. You have to still, the IRS is going to ask for their money. So I love the idea of a magic shield. I mean, I think it's pretty fun to think about and play with, but at the same time, you're going to have to pay it. Someone's going to have to pay the taxes. So rather than trying to avoid it or delay it or pay penalties and fines, maybe the best way to go about it is to spend the time to actually strategize and plan and figure out what the best way to either reduce your taxes or pay the taxes would be.
100%. And not only could that time that you're, not spent on trying to construct this magic shield that is probably not going to work for you anyway, not only could you better use that time to just figure out how to properly pay your taxes, but you could probably better use that time to figure out how to better operate your business and be profitable, right? Mm-hmm. I mean, I think that's the whole thing, is that, when business owners and operators want to spend, excessive amounts of time on financial engineering and tax engineering, that's a red flag that perhaps they're not serious about actually operating the real business, in my view. Well, let's kick it back over to you for the next article you have there, Tammy.
Yeah, sure. So early this week, Best Buy announced that it had agreed to acquire Current Health, which is a remote patient monitoring and telehealth company. This is Best Buy's third acquisition in the healthcare industry. One was for an acquisition of a company that made easy-to-use cell phones and other devices for aging adults, and the other was also in the remote patient monitoring world. Now, when I think of Best Buy, I don't necessarily associate them with the healthcare industry. However, people say that this is a good fit, primarily due to Best Buy's reach with its stores, as well as the fact that their customers trust them, and therefore it's a natural extension to go into the healthcare industry with them. And I think many companies, think about vertical integration, adding extensions to products or service, to their core business when they're building their growth strategies. I think there's a lot to consider when doing so. Like, will you be successful in reaching outside your core competencies? Will you be more efficient? Is it going to be more cost effective? Will customers or consumers make the connection? Or is it just better to stay in your lane? So I thought I would throw that out there because it took me a while. I can see where this could be, a good fit for Best Buy, but at the same time too, it did seem like it's a little bit of a reach, being that Best Buy is really known for being a, electronic retail store, not necessarily a healthcare type of provider. But I thought I would ask you, Ty, if what you think about not only just Best Buy, but how does a company kind of navigate that conversation or thought process of growth strategies and the best way to do that?
Yeah, I've got a couple of parallel thoughts on this one, which may only be somewhat related to each other. But I guess the first one is, so I mean, I can follow along with the notion that, okay, if you accept the idea that there's certain kinds of healthcare services that are becoming technology services, then you look at it and you say, okay, so and that's kind of where my other parallel idea would start. So we'll park that and come back to that point in a second. But if we kind of accept the idea that there's certain kind of parts of our healthcare that are now the domain of retail and technology, okay, then is Best Buy the right company to do that, right, from a strategic standpoint? And so then, they look at it and they're saying, well, it's the healthcare monitoring devices is similar to the kinds of things that we, from a technology standpoint, we sell technology. So they make that leap and say, okay, this is a good industry to get in. But set aside the fact that it's healthcare, and I think there's another nuanced comparison here because that I don't know about Best Buy that could or couldn't be true. But, Best Buy sells computers and cell phones and all kinds of technology. They aren't the manufacturer or the service provider underlying that technology. So why would they be the manufacturer or service provider underlying it, particularly in the healthcare space? I don't get that part of it. Why wouldn't they just sell the devices that are provided and maintained by other companies? Why are they becoming why are they digging into the vertical on this one in particular when they don't dig into the verticals on the other products they sell? At least I don't think they do, but maybe I'm wrong about that.
Yeah, I don't think you are incorrect on that, because I actually went to Best Buy a few months ago to buy a microphone for this podcast, actually. But you go in there, they sell refrigerators. They sell, it's a random amount of stuff in terms of the electronic world, right? So it's interesting to me where I don't think that they're producing it. They're selling it, a lot of name brands situation. Now, what they could say is because they have all these available type of technology in their stores, they're very well, like, strong users, or they know about them. So they can sense and connect the fact that they can help customers or consumers really be able to utilize the devices better, or be able to advise the company who are making them how to do it better, because here's what the users are using. But that's the only connection I could actually get to that. And I think it's not a very strong connection.
Well, as you say that, I'm thinking, well, it could simply just be opportunistic in the sense that the other brands that they sell are established brands in those and so to get into doing that, they would have to compete with an established brand. But maybe it's more kind of just opportunistic in this case, where it's like, well, the brands haven't shaked out to be fully established, so they actually have an opportunity to do it here where they wouldn't necessarily have an opportunity to do it with microphones or computer equipment and other things with established brands.
True. But then the other thing that did make me think about it is I don't see the connection, and maybe they're not. If I went to the couple of the websites of the ones that they just acquired, and it does say Best Buy has acquired us. Well, it does notify it there. But when I was at Best Buy, I didn't see, come look at our healthcare devices. And maybe I just didn't notice it because I'm not necessarily looking for easy to use cell phones in case something happens to me. But, I think if you're going to say that one of the primary reasons for this connection are these acquisitions is because of the customer draw that you have and that you can lead customers to these services or to these devices, then you would think that you'd be really promoting that with that, whether it be in your store or trying to get consumers to understand that you are connected to these resources. So, and maybe it's too early. I think they started, their first one that they purchased was back in 2018, but that's actually, it's a few years ago. So maybe they're, you think that there'd be more about that in terms of if that is another tie to them is that customer base, that they have such, strong customer loyalty and or trust, that they would be using that a lot more in this plan. So I'm not seeing it. That's
Right.
kind of my perspective of that. So it is interesting, but I do think that a lot of companies do, especially in when they're trying to grow and trying to do kind of a quick to grow method. Typically, acquiring is a really easy way to do that. I guess my advice or my thought process on that would be ensure that whatever you're acquiring does somehow really strongly tie to your core, or you're really easily able to make that connection so folks can understand what value you bring when you're acquiring that business and what that means.
Mm-hmm. Yeah, no, I think that all makes sense to me. Now, here's a parallel question and thought, though, which is, I started my evaluation of their strategy, their business strategy, with giving them the presumption that healthcare is being turned into technology and retail. And I would say, well, it is. I guess we can't do anything about that. But I would say, I don't like that scenario. And this, but I position that similar to, I feel that way with pharmacies, that roll out more kinds of in-store healthcare services. It's less of a, there may not be as much of a technology play, but when CVS is, giving flu shots and doing, I guess that's a convenient way to do it. I could do it that way. So I'm not suggesting people shouldn't get their flu shot at CVS, but it just feels to me like they're retailizing. I don't know if that's a word, but they're retailizing medical care, right? And I don't like that trend. And this story kind of plays into that as well. It's retailizing and technologizing medical care.
Yeah, but I will say that probably is the wave that we're kind of riding right now, because you're right. A couple of the things that the article mentioned was the watches and the fit, trackers and all these various different things. And the fact that a lot of technology is used in trying to meet with the doctor nowadays, right? You're utilizing your laptop or TV or whatever it could be to actually have those services. So there is a technical component to it. And then,
well, when you say it that way, I can't take too much objection. If technology is helping us collect more data for our doctors, how can I object to that, right?
I know.
I think what we're going to see, though, is that the data is being evaluated by AI or non-doctors, and a lot of pre-doctor services or without doctor services are going on, and that's the part that bothers me about it.
Mm-hmm. Well, the other thing that now that we're talking about this came through was they were talking about the baby boomers and the older generation that's utilizing these services. And I don't know if that's the people that are using the Fitbits and the Apple Watches and all
Right.
these little technical devices. I can say that I know my parents aren't doing that necessarily. They're going to the doctor physically. They're not even, throughout the pandemic, they weren't necessarily doing a Zoom meeting by any means to coordinate with their doctor. So it was very interesting. I think they were trying to say, here's how it's all connected. I think that they're trying to make the argument that it is, and we may be wrong. Maybe it is a perfect fit and all that kind of jazz, but I do think that that's something that a lot of companies kind of need to look at, because the pharmacy doing the flu shots was a great kind of example of those types of things. When you're thinking it through, does it make sense? I think you can get there, but in some cases where you can't and you're trying too hard, then maybe it is better to think of a different service or product or extension or acquisition that you want to do that's not so different than what you're currently doing. Well, good. I think you have our last article.
Yeah, this one is, and it's not an article per se. It's a tax court case that I'm just going to remark on and kind of ask a question for food for thought. And so this case came out of the Ninth Circuit Court, which is the circuit court that we're in. looking at the IRS assessing a fraud penalty. And what's interesting on this to me is that the fraud penalty, the tax fraud penalty, was assessed against a tax preparer who also was the owner of a cannabis business. But really, for me, the moral of the story, or the crux of the story, is the fact that the person was a tax preparer by profession. And when I first saw the case coming through, I thought, oh, this is a preparer penalty. Like, this person committed fraud in their preparation of tax returns as a professional service. But that's not what the case was about. This was about this person. His name was actually Mr. Chico. Mr. Chico actually committing tax fraud in his personal taxes, in the taxes that in his personal taxes in his personal business. And so, I mean, the elements of the fraud, the elements that caused the IRS to charge him with fraud, and that that the courts agreed with, are pretty like slam dunk classic types of things that I would presume would cause somebody to be charged with fraud, even if they weren't a tax preparer. The issue, some of the issues were things like he didn't have the books and records for his cannabis business, and he refused to provide any documentation of that to the IRS. Simply first, not having books for it is a fraud red flag. Secondarily, refusing to cooperate with the IRS by providing them any documentation is, I think that you basically are in a zone of presumptive fraud there. And then, I'll just leave it at those two things. We don't need to get too detailed with those elements, because just those things alone, it's funny, the courts call those badges of fraud, but just those things alone. Oh, and he refused to file back tax returns when asked to do so. So all of that alone kind of screams, okay, this guy's not doing something right here, and would be subject to fraud penalties. So as I said, to me, that part of it, while it sounds salacious and perhaps the details might be interesting to some, it's not particularly interesting to me, that part of it. What was more interesting to me was the tax court at the end of all this noted that the fact that he was a tax preparer with professional experience in corporate and business taxation meant that there was even stronger circumstantial evidence of his fraud. And that's where I wanted to kind of open this for discussion and ask the question, because like I said, in my mind, clearly this guy is a fraudster, even though whether he was a tax preparer or not. So, what is setting that point aside, I mean, what is it about him being a tax preparer that makes the case against him even stronger? Why do we feel that way, or should we feel that way? The court feels that way, but should we feel that way, I guess, as a society? What do you think, Tammy?
Well, I have a lot to say on this. I kind of went back and forth with myself today in preparation of this discussion. And I would say first, the reason why it's even more just an indication of fraud is because he should have known better. He knows better. And so you take that assumption, and it's like doing all the things that he did, it's more egregious, where you're just like, were you thinking? And would you be advising a client to do this? Like, how would he be viewed, in terms of providing client service if this is how he did his own taxes? So I think that does make sense to me. Now I could go on the other side and say, hey, like maybe I'm not the best tax person or tax preparer, and I made all these mistakes. And then you're holding me more accountable because I'm not good at my job. And then that's not necessarily fair. But the attitudes and some of the things that they were listing, of the things that he did and wouldn't comply with and didn't, wasn't cooperative and didn't provide the information, it just seems that it falls in the first category where he should have known better. And so his actions were a little bit more just wrong and showing that. Now, if he was kind of bumbling along and listed all the things that like, oh, I didn't know that, or I haven't kept up with my CPE or, my accreditation, or I haven't done taxes for other people in years, all those various different things, maybe I could give him a little bit more sympathy. But the way that the case was laid out, it didn't sound like that was the case. It sounded like he knew exactly what he was doing. He was you can paint a lot of, your own story on this, but like when I was reading it, I'm envisioning this person who's just not providing information, being like, I know better, I know more than you, I don't have to do this, I'm this, and like just that attitude and all that stuff is what was building up in my head, where I'm sure that's going to make it a lot worse for the person to try to resolve the particular issue. What do you think?
Yeah, no, 100%. I think all of that is right, and I think you honed in on the thing that is unfortunate about the case is that the facts were so skewed in the sense of, this was not just a mistake, but actually, refusing to cooperate and refusing to provide any documentation and refusing to file your tax returns is basically just, that those things on their own are not mistakes, right? And so, I think about that last statement by the court that, the fact that he was a tax preparer puts even more evidence against him. Makes me think about, well, what if you did have a different fact pattern where, as you said, he was cooperating, and he was providing the documentation. And what if his excuse was just something different? Like, because in this case, it's kind of weird to even say fraud, because it's almost like he's a tax protester. He was just refusing to participate in the system, right? Mm-hmm. But if there were a different case where, somebody just claimed, oh, I just got the answer wrong because I didn't know how to properly file the returns, or I didn't know how to properly do those calculations. Does the fact that you're a professional tax preparer make that excuse less viable?
Yeah, but at the end of the day, it doesn't matter, right? It's not like he's going to get more penalties or more, fines because of that, right? And if they didn't need that one last fraud indicator to say everything, they had enough. It's like almost like Exactly. They didn't have to say it. I think they almost said it like to get back at what they were feeling in terms of his response, right? Now, if there were, and that would be the interesting question, would it be because the person was a tax preparer and should have known better? Should they have been penalized more or at a higher rate, or face some other type of penalties? In terms of doing that, that would be an interesting conversation, right? Because you see people who are in professions and making mistakes within their profession knowingly, you tend to view them and treat them up and punish them a lot harsher than you would with others. So I think that would have been interesting if they came out and said, because of this, we are now going to, instead of giving you a 10% fee or whatever, we're giving you 20% or 30%. That would be a completely different story. Now, would I agree with that? I don't know quite yet, but I think that that's an interesting spin on it. They didn't need that last fraudulent thing. They really didn't, to prove their case. So
what you're saying is I need to look for that story so we can carry on this conversation next time.
Yes.
All right. That's what we'll do. Yeah.
It's an interesting concept. And yeah. And it would be actually, what would be interesting to see too, is that if he was a active tax preparer, if they would prevent him from doing taxes going forward, because right. That would be probably one, obviously, but he wouldn't appreciate that. But if you're doing this on your own, I can only imagine what you're doing for your clients. And that would be putting the public at risk.
Right.
Thank you for joining us for another episode of None of Our Businesses, where we discuss news in business, accounting, and taxes from an accountant's perspective. Please hit the like and subscribe buttons if you're watching this on YouTube, or rate us on your favorite podcast app. See you soon.
Bye, everyone.